A man came into my branch one January absolutely furious, and he was furious with me, which was fair enough because I was the one standing there. His Social Security deposit had gone down, not by a little, by the better part of $300 a month, and it had happened without a word of warning that he'd noticed, and he was certain the bank had made an error. So we pulled it up together, and I had to tell him that the bank hadn't made an error, and that in fact the amount Social Security had sent us was the amount that arrived, and that whatever had happened to the rest of it had happened somewhere upstream before it ever came near our building. Something had been taken out of his check before he ever laid eyes on it. And I want you to hear the part that stayed with me. He had retired 18 months earlier. His income was now less than half what it had been. And he was being charged extra that year, precisely because of how much he had earned back when he was still working. He was being billed for a life he no longer had. My name is Harold Briggs, 43 years in a small-town Ohio bank, branch manager for the last 19. And what happened to that man has a name. It happens to a great many people. And here's what makes me want to sit down and talk about it. In his particular situation, there was a free form, one page, that would very likely have removed the whole thing. He never knew it existed. Nobody at the counter I was standing behind knew it existed either. And I include myself in that, which is a thing I've had a long time to think about. So today, what this surcharge actually is, and why it lands on people who do not consider themselves wealthy. The single most important feature of it, which is that it is a cliff and not a slope, and which almost every explanation of it gets wrong. The 4 situations that trigger it, one of which is coming for a good many of you, and you won't see it coming. The form, by name, and exactly which circumstances it covers. And I'll be straight with you about the one very common situation it does not cover, because I'd rather disappoint you today than have you find out in a letter. Now, the 2 thoughts. The first, Harold, this is a high-income problem, and I'm not high income. Friend, that's the whole trap, and it's why I've put it this early. This does not measure whether you are wealthy. It measures one number on one tax return from one particular year, and a perfectly ordinary retired person can cross that line once, in a single year, for a reason that has nothing to do with being rich, and pay for it. The second thought, my check's the same as always, so this isn't me. It may not be you this year, but this thing looks backward always, so what determines your bill next year has already happened. It's sitting in a return you filed months ago, and that means the useful moment to think about it is now, not when the letter arrives. So here's the machinery. Your Medicare coverage has premiums, and for most people they're deducted straight out of the Social Security payment before it's sent, which is exactly why my customer saw a smaller deposit and no explanation, and why he thought it was us. Most people pay the standard amount and nothing more, but above a certain income line, an extra charge gets added on top, on both the medical side and the drug side. In the trade, it goes by an acronym I won't make you memorize. What matters is that it's an income-related surcharge on your Medicare premiums. And here is the first thing that catches everybody. They do not look at what you earn now. They look back 2 years. So the premium you pay this year is set by the tax return from 2 years ago. And it's a specific figure off that return. Essentially, your adjusted gross income with any tax-exempt interest added back in. So if you hold municipal bonds thinking they're invisible here, they aren't. They count for this. That 2-year delay is the whole cruelty of the design. It means that the year you retire, the year you finally stop, is the year that will define what you pay when you're 2 years into retirement and living on far less. Which is exactly what happened to the man in front of me. Now the part that matters most, and the part I want you to remember if you remember nothing else. This is not like income tax. Income tax is a slope. You go into a higher bracket and only the money above the line gets taxed at the higher rate, so crossing a line by $100 costs you a few dollars. People assume this works the same way. It does not. This is a cliff. There are steps, and if your number lands one single dollar over a step, you pay that entire step for the whole year on both your medical premium and your drug premium. $1 over the line, and you owe the whole thing. Not a proportion of it, all of it. And I have seen explanations of this from people who ought to know better, describe it as though it were a normal tax bracket, and that is not a small mistake, because it is precisely backwards about what you should do in December. If it were a slope, being a bit over wouldn't matter much, because it's a cliff. Knowing where the edge is can be worth well over $1,000 from a decision as small as whether you take a withdrawal in the last week of December or the first week of January. Quick pause. My ebook, You Earned It Twice, lays out 52 plain English calls to make on Medicare, taxes, Social Security, and household bills. It's the first link in the description. I'm not going to quote you the thresholds, and here's why. They move every year, and I'd be handing you a stale number that somebody repeats in 3 years' time. What I'll tell you is the shape. The first step sits at a level that a comfortable but entirely ordinary retired household can cross in an unusual year, and the figure for a married couple is roughly double the single figure. Hold that thought about the doubling, because it comes back later in this video, and when it does, it's going to matter to somebody watching. So, the 4 situations. Number 1, and this is far and away the most common and the most unfair feeling. You retire. Your final working year, or the year you cashed out accumulated leave, or took a severance, or sold something to tidy up before you finished, is a big year on paper. 2 years later, that's the return they're holding. You are now living on a fraction of it, and you're being charged as though you were still earning. Number 2, you sell a property, a house, some land, a place that's been in the family. Number 3, you take an unusually large withdrawal from a retirement account, or convert one kind of account to another, and the whole amount lands on that year's income. And number 4, and this is the one that ties back to what I talked about last time, you become widowed. Because remember what I said about the couple's threshold being roughly double the single one. When your spouse dies, you don't only lose one of the 2 Social Security checks. Within a year or 2, you're also being measured against the single person's line instead of the couple's, which is around half of where it was. Less money coming in, a line that's dropped to meet you. It is, I'm sorry to say, a fairly brutal piece of arithmetic, and hardly anybody sees it coming, because these 2 things sit in completely different filing cabinets in a person's mind. Let me stay on the house for a minute, because a very popular video going around on this subject frightens people about it, and the truth deserves better than that. When you sell your main home, there's an exclusion. As things stand, a single person can exclude a substantial gain, and a married couple roughly double that, provided you've owned it and actually lived in it for enough of the last 5 years. And only the gain above that exclusion counts toward the income figure we've been discussing. So for the great majority of ordinary people selling an ordinary family home, this whole issue simply does not arise, and I'd rather you slept well than worried about a thing that isn't going to happen to you. Where it does bite is where the gain is genuinely large, and where it bites hardest is a case nobody warns about. Somebody who bought a modest house decades ago in a place that has since become expensive. They don't feel wealthy. They've lived in the same house for 40 years. But the gain on paper is enormous, and paper is what gets measured. If this is useful, hit the like button, because there's somebody watching who's about to make a December decision they'd make differently if they'd seen this. And subscribe. I put one out every day. Now, the form. This is the part the popular videos leave out, and it's the reason I made this one. There is a 1-page form, and its actual name tells you what it does. It's the Medicare Income-Related Adjustment Form for a life-changing event, and it carries a form number in the SSA 44 family. So if you ask for it by the life-changing event form for Medicare premiums, any Social Security office will know exactly what you mean. What it does is say, the return you're looking at describes a life I am no longer living. Here is what happened, and here is what my income actually looks like now. You file it with evidence, and if you qualify, they set your premium using your real situation instead of the old return. So which circumstances count? As the rules stand, the list runs roughly like this. You stopped working, which covers retirement, and this is the big one. You reduced your work. Your spouse died. You got married. You divorced. You lost income-producing property through a disaster or something else outside your control. You lost pension income. Or you received a settlement from an employer because of bankruptcy or reorganization. Now look back at my list of 4 triggers and notice something. Situation 1, retiring, is squarely on the list. Those 2 are, between them, the majority of the people this happens to, and an enormous number of them never file, because they get an official letter with a number on it, and they do what decent people raised in this country do with an official letter, which is assume it must be right and pay it. And now the honest part, and I promised you this at the start. Selling your house is not on that list. Neither is a large withdrawal, nor converting a retirement account. Those are one-off spikes in income, but the rules do not treat a one-off spike as a life-changing event, and I'd be doing you no favors by implying otherwise. Now, There is a mercy built into the design, which is that because it looks back 2 years, the effect is generally temporary. The high year rolls out of the window and your premium comes back down. So for a house sale, the remedy isn't a form, it's the calendar, and it's the arithmetic you do before you sign anything rather than after. Which is precisely why I want you to know the mechanism now rather than in a letter. And I want to say something about that letter, because the letter itself is part of the problem. It arrives in the back end of the year, in among everything else that arrives at that time of year, and it is not a bill, and it does not look like a threat. It is a courteous notice telling you what your premium will be. It is correct, in the narrow sense that it accurately applies the rule to the return they hold. Nothing in it is a mistake. And that's exactly why people don't challenge it. There's no error to point at. The number is right. It's the year that's wrong. And a letter that contains no error is an extraordinarily difficult thing for a careful, law-abiding person to argue with, because they've spent their whole life being the sort of person who pays what the letter says. I watched that instinct, which is a good instinct, and served these people well for 70 years. Cost them thousands of dollars in a situation where the only correct response was to write back and say, "This describes somebody I used to be." 2 more practical things. You do not have to wait for the letter to be wrong before you act. When you're first coming onto Medicare and you've already retired, that is exactly the moment to raise this, because otherwise your first premium is going to be built on your last big working year. Say it at the outset. And second, if you do get the letter and you believe it's wrong, there is a time limit on responding. So this is not a thing to put in the drawer with the intention of dealing with it in the spring. Deal with it in the week it arrives. Now the question that ought to be forming, and it's the one I asked myself for years. If there's a free 1-page form that fixes the most common version of this, why is it not simply handed to every single person who retires? And the answer is the one I keep coming back to on this channel, and it's duller than a conspiracy and in some ways worse. Look at who would have to hand it to you. Your former employer has finished with you. You left. The Social Security office administers what's in front of it. And there's nobody there whose job is to look at a return from 2 years ago and wonder aloud whether it still describes your life. Medicare bills, it doesn't investigate. And the bank, my own trade, could see the deposit change and could not have told you why, because the deduction happened before the money reached us. And I genuinely did not know what I was looking at for the first 20 years I was looking at it. Everybody in the chain is doing their piece correctly. Nobody's piece includes the question. And there's one more thing, which I'll say plainly because I think you can take it. The people who most reliably do know about this form are the ones being paid to manage money for people wealthy enough to have advisors. They know, and their clients file, and their clients don't pay it. It isn't hidden from anyone. It's just that finding out costs you either an advisor or a rainy afternoon, and one of those is free. Let me tell you about 2 men, and I banked for both of them for over 30 years. And the difference between them was not intelligence and it was not money. The first is the man from the beginning of this video. He got his letter, and he did what he'd done his whole life with official correspondence, which is take it at its word. He paid the surcharge on his medical premium and on his drug plan, month after month, for 2 full years, until the high year finally rolled out of the window. When I later did the arithmetic on what those 2 years had cost him, it was several $1,000s. And every dollar of it was recoverable at the time by a form that was free, that fitted on 1 page, and that he qualified for cleanly, because I retired is at the very top of the list. And the second man retired the same year. His daughter, who worked at a school and had no particular financial expertise, but did have the habit of reading things properly, looked at his letter and said, "This is based on the year you were still working. That can't be right." And she asked, and that was it. That was the entire difference. One of them had somebody who asked a question, and the other one had a letter and good manners. I've thought about that a great deal, because it tells you what these gaps are really made of. Not intelligence, not money, just whether one person in your life happens to ask. And before the checklist, one more word to the widows and widowers watching, because when I laid out that arithmetic earlier, I could hear how heavy it sounded, and I don't want to leave it there. Yes, you are hit from 2 directions. And I'm not going to pretend otherwise. But look at where those 2 directions differ. The income falling is a fact, and there's nothing to be filed about a fact. The threshold halving, though, arrives at exactly the same time as a qualifying life-changing event, because the death of a spouse is on that list, near the top of it. So of all the things that happen to a person in that year, and most of them cannot be helped at all, This specific one has a piece of paper attached to it. That's a small mercy, and I know it's a small one. But I spent 43 years watching people in that year have absolutely nothing they could do. And here is one thing that can actually be done, that takes an afternoon, and that puts real money back into a household that has just lost a great deal of it. So if that's you, or if that's your mother, please don't let this be the thing that goes unclaimed, because the year was too hard to think in. So here's your week, and it's 4 lines. 1. Work out which year they'll be looking at, which is simply 2 years back from the year in question, and find that return. 2. Look at your adjusted gross income on it. Add any tax-exempt interest, and know that number. 3. If anything on that return described a life you're no longer living, particularly if you retired, cut back your hours, lost a pension, or were widowed, then go and ask for the life-changing event form. Ask by that name. Bring evidence of when you stopped and what your income is now. And 4. If you are planning anything large in the coming year, selling a property, a big withdrawal, a conversion, ask one question of whoever helps you with your taxes before you do it. And here is the exact wording. What will this do to my income figure 2 years from now, and does it push me over a Medicare threshold? If the answer is that you'd clear the line by a small margin, that is a cliff you are standing on, and there may be a great deal of difference between doing that thing in December and doing it in January. And send this to somebody. Anybody retiring this year or next needs it before their first Medicare letter arrives, not after. And anybody recently widowed needs it, because they are being hit from 2 directions at once, and one of those directions has a form. Then leave me a comment, and this is what I want to know. Has your Social Security deposit ever gone down without a clear explanation? And did anybody actually tell you why? Because I have a strong suspicion that a lot of people watching have been paying this for years without ever knowing what it was called. Say so below and you'll be doing somebody a favor. I read everyone. And subscribe, because next time I'm doing the Medicare decision that is easy to make at 65 and can be very nearly impossible to reverse at 75. Most people choose it in their first week on Medicare, in about 20 minutes, usually on the recommendation of somebody who's paid when they say yes, and they have no idea that a door closes quietly behind them when they do. Everything I've shared today is general educational information from a retired banker. It is not personal financial, tax, medical, or legal advice. Medicare premium thresholds, surcharge amounts, exclusion limits, qualifying events, and filing deadlines are set by the government, vary by circumstance, and change every year. Confirm the current rules and the current form directly with the Social Security Administration, and talk to a qualified professional before making a decision about a property sale or a withdrawal. That is not me covering myself. That is just sound banking. Look after your money. You earned it twice. Once when you worked for it, and once when you kept it. If you want more plain English warnings like this before a quiet rule costs you money, subscribe to the channel. I'll see you in the next one.